You have had plenty of testimonies of many people, so I did whole seminar for already as a tribute yet either. So my introduction will be quite short. But often we say that some people are the heart and soul of the party. For me, Peter was the heart and soul of the whole finance, particularly finance community. It's been inspiring so many people, and I've been blessed to have my paths crossing quite a long time ago, actually 30 years back, when it was a discussion of a paper of mine. We met so many times in so many different places, and actually for 6 years of Bloomberg, I was every day in front of him. So every morning he was sharing the ideas of the night, and we were discussing it. So it was always very interesting and enriching. I co-taught board of the World University, the first free online certified master program. So we have shared really absolutely plenty of things. So now, today, my technical contribution is strongly influenced by his tastes, his taste. Here, actually, what we have, it is 3 topics, all revolving around Black-Scholes. Peter loved everything Black-Scholes, everything related to Black-Scholes. So the first topic will be a sort of alternative derivation of the Black-Scholes PDE with different principles than the usual ones. The second one may look a bit sort of controversial. It's arbitraging Black-Scholes. So essentially it's to show that if you're in an economy where every day the Black-Scholes model prevails, so it means the implied volatility surface is flat, is constant, but that level moves from one day to the next one, then you have an arbitrage. And for a long time, I thought it was quite easy. I talked about it, and I realized that to do it fully was slightly more complex. Last point, it's a high strikes implied variance cannot rise. It is a sort of a dual formulation from the one by the late Steve Ross in the paper with Ingersoll and Dupire, was saying that if the interest rate, if the yield curve has a flat asymptote for very long maturities, this flat level cannot fall. For volatility, we have a sort of opposite conclusion. So let me start with the first point, another proof of the Black-Scholes-Merton PDE. Actually, it will be of the forward PDE and not of the backward PDE. So it means it will give you a relationship between the price today of options of all strikes and maturities. It's just an alternative way to get the price of a given option. So alternative to the classical backward PDE of Black-Scholes. But interestingly, we are not going to use the classical arguments of the standard Black-Scholes proof, which was, so it means and also we avoid other techniques used by different people. So in short, we have no hedging argument, no arbitrage argument. We are not going to change the measure to go into a risk-neutral measure. We are not going to invoke local time properties or Tanaka formula. It will be just using Ito's lemma and basic accounting. So here we are. We assume that the classical SDE for the evolution of the stock price. To make it simple in the first step, we assume no carry. So it means no interest rate, no dividend, no lending, no borrowing cost. So we have a European payoff F, and we simply, so it's just a function of the spot price, and we apply Ito's formula to this function of S, not S and T, just F of S. So you have the classical 2 terms. So the first order term, F prime of S ds, plus the second order term from Ito's formula. with the second derivative of f. So now we are going to study this very simple relationship to interpret it in terms of how much it costs to increase the maturity of the option, let's say from capital T to capital T plus delta T. So basically, once you arrive at capital T, you have to pay, you have this quantity that corresponds to the cost of extending the maturity. The first term, the f prime of s ds, actually is costless in the absence of carry, because indeed you obtain it just by buying the stock at time t, f prime of s units of stocks at time t, and selling them delta t after. So the cost of it is sigma square s square over 2 f double prime of st. So interestingly, this cost can be interpreted today as the payoff of another European option. Actually, this is a function of S, and as you know, it can be decomposed, for instance, with the Carr formula in different calls and puts. So we are very fortunate, actually, that we are dealing, when we apply this to call options, because this term on the top, which is the cost of the option, of the extending the maturity, actually, in the case where F is a hockey stick payoff, we have two magical simplifications. So the first one is that the second derivative become a Dirac mass, so it's concentrated in one point. You do not have to integrate over a whole range of strikes. And the second thing is that this Dirac function can be seen as a limit of butterfly spreads, so which are combination of call options. So the combination of those two things allow you to have something very simple, which is that, so in the case of the hockey stick payoff, as you see at the end of the first line here, this the cost of extending the maturity of the option, once you're at capital T, it's just this Dirac, as I said, because of the second derivative of the hockey stick. And we can value it very easily at time 0, because as I said, the Dirac mass is a limit of butterfly spreads, and they can be seen as finite difference of the second order derivative. So it has also, as Bruno and Litzenberger showed, a price at the cost, the value of it at time 0 is sigma square k square over 2 times second derivative of the call with respect to the strike. So as this quantity corresponds to the marginal cost of extending the maturity, we can write it also as the maturity derivative of the call price. So what you obtain, eventually it's this forward equation, so which gives you obviously the same solution as the Black-Scholes PD. So again, it was no hedging, no arbitrage, no change of measures, no Tanaka, just Ito and accounting. Now, when we have a slightly more complicated setting, when we have interest rates, for instance, or dividends, so different carry terms, actually we have more good surprises. It is that if those quantities are expressed in a simple way, like constant or function of time for the interest rates, and same thing for the dividends, actually those terms, the contribution of those terms can be expressed also with respect to the call prices at the at time 0 as derivatives of them. I want to make it to emphasize the fact that it's very fortunate, because if you had, for instance, the interest rate being a function, a nonlinear non-affine function of the stock price, then it would not work. So here we have a combination of good surprises, which gives you internal forward equation. So obviously, this is a sort of a simplification of the local volatility model. So you have the same results when the volatility is also a function of a spot and time. So now let us move to the second topic, which is arbitraging Black-Scholes. So what does it mean? Imagine an economy where the implied volatility skew, or the whole surface, is flat every day, but it may change from one day to the next one. It's not a total fiction. Here it's an example of commodity market. So it's a copper market. So you see here the implied volatility skews those are those two curves in red and white. So it is for the same maturity. The implied volatility is a function of the strikes, but separated by a couple of days. And the levels are, so two things. The first one is that each of the curve is pretty flat. It's not like what we have in equity with a very strong skew. Second point is that the difference of the levels is quite substantial. Basically, it moves from 21% to 25% just in a couple of days. So it's a sort of illustration that this assumption of a flat level that may change is not so absurd and quite well mimicked by some securities. So how would you arbitrage? Is there an arbitrage in the Black-Scholes model in this case? So here I look at a simplification. It's actually the Bachelier model, and I run you through an argument I have presented quite a few times many years ago at different conferences. And it looks quite convincing, but I will show you how flawed it is. And it's a little bit flawed, actually, and how it can be corrected. So the idea is to build the positions in options which will cancel most of the Greeks. So if you're in the Bachelier model, to make it simpler, to make the point clearer, so you have plenty of symmetries. So it's natural to look at mostly two different options. One will be an at-the-money straddle, or combinations of options. The second one would be a symmetric strangle. So the straddle, it's an at-the-money call plus an at-the-money put. And the strangle, it is an out-of-the-money call plus an out-of-the-money put, and we take them symmetric, so they are equally out of the money. When you look at, in this little table, at the sensitivities, the Greeks of those two option positions with respect to the stock price and the volatility and time. So we look at the derivatives up to the order 2, because this is what matters in the Ito calculus. And we don't need to do it twice with respect to time, actually, because it has no quality variation. So if you assume that the volatility follows an Ito process, for instance, so you can look at which derivatives are zero. So as those two positions are symmetric, there is no delta, so no sensitivity to S, the stock price, neither no Volga, which is the second order derivative, cross derivative with respect to spot price and volatility. So if we take those two options portfolios with the same maturity, then actually we have a proportionality in Black-Scholes and Bachelier between the gamma, the vega, and the theta. So it means that if you cancel one of them, if you combine the two options to cancel one of them, it will cancel everything. We achieve this by, for instance, canceling the gamma. So we look at the strangle minus a ratio of the gamma of the straddle. So this is a new option portfolio which has no gamma, and as everything has the same maturity and we have the proportionality, there is no vega and there is no theta. So as it's symmetric, we still don't have the delta or the volga, and we are left with a single second order derivative, which is the volga, the second derivative with respect to volatility. So here it seems we are done because we're immunized with respect to everything, except that we capture any vibration, any quadratic variation in the volatility. So it looked quite convincing, but having a second look at this, you can see it cannot be true. It cannot work, at least with just a single maturity. Why is it so? It's the maximum principle for PDs, partial differential equation. So here in this graph, we have two axes. So the y-axis is just the spot price, and the x-axis is not time, but it's the residual variance. So typically it would be the sigma squared times capital T minus small t. So the thing is that if you're currently at the end, so it looks a bit like a crab claw, let's say. So if you are at the end, compressed between the claw, actually you can see that okay, blue is positive and red is negative. So if you move horizontally or vertically, actually you go into the positive territory, but it cannot be blue all around, because maximum principle will tell you that basically if it's positive all around, then the value at that position has to be zero. Actually, and it is absolutely true when you look really at the value function as a function of residual variance and spot price, you get this positive and negative picture. So again, blue is positive and red is negative. So this tells you that there is no hope to create an arbitrage with just a single maturity. So what can we do? We are going to work a little bit more. So let's go to the famous log profile. In Black-Scholes, it has a very simple expression of the price. So the log profile gives you the log of the spot at a certain maturity, and you can compute its price for a given value of spot price, given time and given volatility. So you get the log of the current spot price minus sigma square times capital T minus T over 2. So if you combine two such contracts, if you look at a calendar spread of such contracts, so it will eliminate the log of S. And if you normalize by the difference of the maturities, so you get that this log calendar spread actually has a value which is directly minus sigma square over 2. So we have eliminated the dependency in time and in the spot price. So this is a portfolio of options. So, you know, the log requires a strip of options over all strikes, and we do it over two maturities, T1 and T2. So essentially, in that case, it's a log, it's concave. So you sell the T2 options, you buy the T1 options with the 1 over k square weighting scheme that you have in the VIX formula, for instance. So this position is really minus half the variance, sigma square over 2, and it's wherever the spot price is and at any time before T1. So this position is capturing this variance. So it's not enough to do an arbitrage. We have to go a bit deeper and to look at a payoff that gives you the square of the log. So it has a slightly more involved expression. The price today as a function of the spot price, the time, and the volatility. And now if you do a butterfly of those log square payoff, butterfly in time, in maturities, T1, T2, T3, actually you manage to capture sigma to the power 4 over 4. So it's a static position in options that has a value through time that purely reflects, the square of the variance. So by combining those two things now, we manage to essentially, we kill the delta initially. We combine all those options to obtain a portfolio whose value is the current volatility squared, sigma squared, minus the initial volatility squared, or this to the squared. So what does it mean? It means that if at any time the flat volatility level differs from the current initial one, then you make a profit. So it was more involved than the naive one maturity approach. Here, you need actually a combination of 3 different maturities and a continuum of strikes. So now the last topic. So deep out of the money implied variance can never rise. I had presented it at the Bloomberg Quant seminar that we call a BBQ seminar, actually when Steve Ross himself was the keynote speaker, and as a sort of a tribute to Steve, so I presented a version in volatility of what he had done in the interest rates. And why do I talk about it now? It's actually because I think it was my last exchange with Peter. It was linked to this work. Peter sent me a message saying that he was intending to talk about this and he wanted to quote my work and he wanted to have a reference. So it's an opportunity for me to go back to it, but again, having in mind our dear friend, Peter. So here a quick review of the Deep-Wing Ingersoll-Ross. It was 96. So if the zero coupon rate has a limit when the maturity goes to infinity, so we are at a certain time, small t, and we look for different maturities, capital T. So if there is always a limit like this limit can never fall. So it's due to the fact that you can create positions with extreme convexities and that remain positive. So the idea is that we look at individual zero coupons, and we will, of different maturities, we will build a portfolio of them with an infinite number of maturities, but a discrete one, in such a way that still the cost of this portfolio initially is finite. It's $1, let's say, or it can be done as little as 1 cent or billionths of a cent. So how does it work? Let's assume, for the sake of the argument, that the current yield curve is flat at 5%, and you look at the price of different zero coupon of different maturities when you change the level of this yield curve. So it means you will discount that payoff at different rates. So the good thing is that when you discount actually at a higher rate, so your money loses value but never becomes negative. And if the interest rate go down, actually your zero coupon increases in value. This is true for each of those zero coupon of different maturities. To make it simple, think of it with integer maturities. And so here we buy a number of them. So from the former slide, so the cost, sorry, I'm just going back. Oh, sorry, here. So you buy actually exponential of R0t of that one. So it would be a cost of $1, but you divide by the maturity times maturity plus 1 to make the series converge here when you consider a portfolio of an infinity of them. When you look at the value of this portfolio tomorrow, if the rates change, so basically it will decrease in value if the rates go up, but still remaining positive, and you could have started from a totally minute, minuscule minuscule investment. But if the rates go down, then you become immensely rich. So essentially, this tells you that if you always have a constant asymptote, if you have an asymptote for the long-term rate at any point in time, this level can never fall. So let's look at what we can do with in the volatility world. So for instance, the best proxy for rate when we talk about volatility. So if we just want to look at the term structure, it would be the term structure of the variance swaps, because they are not tied up to a one specific strike, and they reflect an aggregate level of volatility. So what can we say? So what would happen if you have at every point in time a term structure of variance swap being flat? So it converges to a certain level, but this level may move from one day to the next one. Is it possible? Is it a problem? Actually, it is possible, and it is not a problem. For instance, here, if you have a model where, so VT would be the instantaneous variance, and if itself is a martingale, if it is itself a martingale, then you can check that a model like this is generating at each point in time a flat term structure of a variance swap. So actually, it would be flat at a level which is a current instantaneous variant. And this will move like a martingale, because we assumed that the instantaneous variance was a martingale. And so it means that this will not be exploitable. So if we want to find a sort of a similar result to the Ross Dybvig-Ingersoll result of the rates, if we want to find something sort of equivalent for volatility, we have to do something different. And it is the following one. It is that if you assume that every point in time, actually for a given maturity, and we are looking at a fixed calendar maturity, not a relative maturity, like let's say end of the year, for instance, we take. So if we assume that on a certain market, the implied volatilities are converging to a fixed level, like for instance, when the strikes go to infinity. So here we are going to show that this level can never increase, actually. So we're going to do something very similar. So which is, we consider a portfolio of options of different maturities. And for instance, you can take integer maturities, and we take them, we buy a number of them such that the total cost remains finite. So when we look at the value tomorrow, so we'll have something very similar. So essentially, we have a position which is highly convex in volatility, and if the volatility decreases, so you lose money, but it remains positive. And the increasing convexity when you increase the strikes means that when you have the whole infinite portfolio of options, so the price of it goes to infinity as soon as the volatility level has increased. So that's the volatility equivalent in some sense to the Dybvig-Ingersoll-Ross result, but with far out of the money options as opposed to long maturity bonds. Sorry. So is this interesting or important? Yeah, actually, on the market, many modelings of the implied volatilities lead to a constant level. I just give you an example here on currency markets. So the options are not quoted in price, or they are not quoted in implied volatility. I mean, in price, this would be like equity markets. They are not directly quoted in implied volatilities as a function of the strike, but rather as in terms of the delta. Actually, it's at the money vol, risk reversal, butterflies, but they can be usually they are recomposed in terms of the delta as a collection of implied volatilities. Now, the problem is that when you want to interpolate or extrapolate from a finite number of the strikes from the market, you have to make some assumptions, and most of the time, it's something simple, like for a long time, people were using a quadratic fit to the market in delta space, for instance, obtaining something like this here. So, but when you do it on the delta space, which is between 0% and 100%, if you have a usual interpolation, it means it will be bounded. When you express it back in terms of the strikes as opposed to the delta of the option, it leads to, so on the left-hand side, it was in terms of delta. On the right-hand side, it is in terms of the strike. The fact that the interpolation was bounded in delta means that when we stretch it into the strikes, so it will lead to exactly the situation I described, which was constant, so a finite asymptote at every moment in time. And you may say, okay, but that's not necessarily a big problem. It may be actually the market has understood that, and it is not going up and down. And actually, it is going up and down. So we looked at it. It was a few years ago. So I think it was the euro against the dollar, probably. And it does go up and out, up and down a lot. So what does it mean? It means that if a market maker was brave enough to follow this simple approximation, interpolation, and was offering a negligible bid offers, so it could be directly arbitraged. So to be, we are reaching the conclusion now, but I want to make it clear that actually more precisely, the quantity that cannot increase in the case of this existence of asymptote for a very high strike, it's not really the volatility itself, it is the remaining variance, which means the quantity sigma square times capital T minus small t. So now we reach this is a conclusion of this part. So which is the results are the Rost Ingersoll-Dimfig was that the long-term rate can never fall. So I showed that the long-term variance swap can fall or rise, but the deep out of the money variance can never rise. So this concludes this presentation with those three references to Black-Scholes, which was the model that Peter was always going back to. And so I thought it was a good inspiration for me to present this work and to share it to the community. And so now I will leave the floor to questions, and we should definitely not forget to celebrate all the achievements of Peter. As I've always already said, it is in the south of France, and it seems in other places, they say that people usually they die twice. Once, the first time when they pass away, the second time when they are forgotten. So in the case of Peter, let's make sure he's not dying twice. Thank you.
Thank you for this wonderful trip through the world of Black-Scholes, Ingersoll-Ross, and thank you for the glimpse at your interactions with Peter.
Thank you.
Do we have any questions first here at the audience and then on the online Q&A? And let me remind everyone joining virtually that there is a Q&A box. You're encouraged to ask questions at any point. Do we have any online?
As some people say, if there is no question, it means I've been very clear. But
it has been very, very clear indeed. We have one here.
Hi, good morning. Thank you very much for the talk. So I'm a practitioner as a market maker in interest rate options, and I thought your talk about the perpetual bond and the incremental gamma you get, for example, if you did 30s versus 50s curve, is positive, which is quite interesting. I was wondering if you can put it in the framework of a CMS swap, where the gamma is also pretty consistent, where the payout is linear as opposed to a convex bond, and if there's an arbitrage in that sense.
It's very strongly relying on this convexity and this non-linearity, and really on the behavior of this discounting function when you assume that it's flat for all maturities. So if you have a payoff which is linear in the rates, unfortunately, or fortunately, I don't know, but it would not work. So really the essence of this arbitrage, if you want, or this portfolio which is showing the impossibility of the long rate going down, it's really due to the fact that you have both a high convexity and you're bounded from below by zero. And again, as I've explained, we have the same behavior with options with respect to volatility. Just the difference is that, in that case, it would be creating an infinite wealth is if the volatility levels is going up. So it's the opposite result, but both results are based on this principle of positivity and convexity. And when you can combine instruments of different maturities or different strikes with an increase in convexity, you can sort of create an artificial infinite convexity, if you want. And this is the core of the argument.
Right. That's very interesting. I almost feel like that means that long-term rates have a cap, like they can't go up too much because people will buy for this almost free convexity. Obviously, if it went too low, then it almost feels like it's completely priced in. Another thought that came to mind when you put together the construction of uniform or flat gamma, but long vol through the strangle versus straddle idea is a forward vol contract in swaptions, for example, where you basically, a client can own volatility without the gamma. And there's a very, I guess, clear replication strategy. It seems very similar to the strategy or the portfolio that you created there. I think in that structure where you have flat variance, the customer is sensitive to the implied vol mark to market. In your construction, does it have a similar feature where you have risk to implied vol, or is it a pure arbitrage without the sensitivity?
Actually, yeah, it's a very, I think you're very right. But the most important thing is that the first view at the arbitrage, and it's what I had done years before, it was trying to get, let's say, free gamma or 3 theta. So canceling everything else and having this, basically this free convexity left on the table. But actually, so what I explained in the second part of this, of the topic of the parallel shifts of Black-Scholes, it is that actually it's not necessarily enough So it's true, those strategies would capture the quadratic variation of the volatility, for instance. So it requires volatility to vibrate, but it's not working in all possible scenarios. So I think the interest of this, of my, the second topic I showed, so the flat Black-Scholes that moves up and down, it was to show it's possible to build a portfolio that ensures a profit whenever the level is moving, and whichever way it does it, whether it is violently or very smoothly. There have been related work, actually, notably by the great Chris Rogers and Mike Terranci, which was actually spurred by the question of Steve Ross, because he had asked to several people whether volatility had a result equivalent to his on the rates. And Rogers and Terranci had shown that basically, yes, it would be arbitrageable, but without exhibiting an explicit portfolio. So again, my point is that one simpler view of it is just trying to have convexity for free. A more complex one is to have a result which holds for all possible scenarios, and together with an explicit arbitrage portfolio, which captures the change in the level. So which I showed, where typically, if the variance moves from the initial level, wherever the spot price is and wherever this variance level is, it's a profit.
Got it. Thank you again.
Thank you.
Any questions from the virtual Q&A? If not, thank you so much again. There's a very short coffee break on the agenda, and we'll gather back at 9:45 for a presentation by Jim Gatherall.
Thank you.
Thank you.
Bye.